So in today's FinLit session, we look at how markets have changed coming into 2024 and what kind of asset classes, what's are more attractive right now, and also in terms of what is actually changing in terms of the financial market landscape. So we look at a couple of things. One is starting off with how our calls have been so far in terms of what we've recommended during the last few times, and what our expectations are on the macro front in terms of interest rates, inflation, and so on, and also look at what kind of investment options are available for our clients right now. So our last session, I think we had it in September 2023. On the interest rate front and inflation front, we mentioned a few things. We were expecting a 200 basis points reduction in policy rates. And actually, there was a 200 basis points policy reduction, one in October, one in December. And now the policy rates are between 9 to 10%, which is what we exactly expected in the September session. And inflation, we expected an average of about 20%. I think for the year, Sri Lanka closed at 18%. So we were close in terms of predicting that significant downturn in terms of inflation to accuracy. Also, from an interest rate perspective, the decline that we expected on the Treasury bill rates did happen. We are seeing that actually there was probably a month late in terms of it realizing, but in January, the rates have come to the range that we were looking at in terms of the 12-month bill being between 10 to 12%, which is right now at 11%. Prime lending rate, however, on the other side has fallen faster than expected. By December end, it was at about 12.8%. And today we are close to about 11.8, 11.9%. Right? So more or less, our trend in terms of what we were expecting from a macro front, both on interest rates, currency, the economy, in terms of growth and so on, has been more than accurate in terms of what we were looking at. Right? So from this point, what has changed? What are the key things that have changed in the market, and how have our expectations changed? So the key thing that has changed is obviously on the interest rate front. Right? Now, this graph may look a little bit confusing, but I'll just explain how this graph works. This is basically the government securities rates on the government securities. Right? The blue line shows what the rates are now for 3 months, 6 months, going up to the 20-year, 30-year bond. And the red line shows what these rates were about a month ago. Right? For example, the red line, which shows a month ago rates, the 3-month was at about 14%, which has now fallen to 11% or so. Right? So that's how we interpret this yield curve. Right? So what has happened is a month ago, the short tenor, the 3 months, 6 months, 12 months was higher compared to the long-term rates, which is not a normal phenomenon. It happens mostly when it's in recessionary conditions, when there's monetary tightening to a certain extent. That's when you have that scenario. And like what we expected, that correction has now happened, and now you're seeing a more normalized curve. Right? So normalized curve is the short-term rates are now lower compared to the long-term rates. Right? And in a normal economic environment, particularly in an accommodative stance from the central bank, this is the kind of yield curve that you will most likely see. Right? So the normalized curve will continue, where short-term rates are going to be lower, and the long-term rates, there might be a smaller premium compared to huge premiums on the long-end interest rates. Right? So from an interest rate perspective, right, the tenor differences has kind of adjusted, but we feel that there could be one more policy rate, and that could cut, which could be fueled by the inflation. Right? So even though during January we saw a spike in terms of inflation going up to about 6.4%, this was mainly driven by the VAT and actually the vegetable prices increasing because of the the higher rainfall. Right? So this is correcting now. So with weather conditions kind of adjusting now, you're seeing vegetable prices easing off again. Right? The main thing in terms of VAT adjustments is fuel, electricity, and so on. Those are here to stay. But when you look at the market, a lot of the companies have not been able to increase prices, right? Which is why we feel that overall, when you see food prices starting adjusting down, inflation will revert to about 5 to 6% in terms of the range that we're looking for 2024, which is an okay level and within the central bank's range of 5 to 7%. So it's not a major concern going into 2024, right? So food will be a main adjustment, and obviously there's a base effect coming in from last year. So inflation is not going to be very high. And that is also driven by central bank not printing money like what they used to before, right? So the graph here shows the printing every quarter, how much of printing that the central bank was doing. And if you look at towards the latter part, in 2Q, 3Q, and 4Q, the central bank has actually reduced or paid back a lot of the bonds that they have actually bought, right? So the printing phenomenon has eased off. And also there is a target that the central bank is working towards in terms of reducing the amount of money printing available in the system, right? So IMF has given a target, and we are expected to reduce our money printing or printed money by another 200 billion going into by third quarter of 2024, right? So without money printing being there, a lot of the demand-driven inflation that we've seen in the past, the currency depreciation, the spiraling effect on inflation is not going to be there like before, right? So it's a good thing. So the government is running entirely on its tax collections and rolling over its maturities from the public, rather than using monetary financing or printing money to manage its expenses, which is a good improvement that we've seen from a central bank perspective over the last 3-4 quarters. And even though rates have come down, we feel that there might be one more policy rate cut that we can expect going in towards April to June. And why we say this is because even though rates have come down, the economy is still taking a breather. Economy is recovering, but it's not recovering to the extent that the central bank would want to see, right? And that is because of the tax impact that came in January. You've seen the recovery that we saw in the months of November and December kind of easing off, and a slow economic phase during the month of January, right? Which may kind of put some pressure when we come into the first quarter GDP numbers. And this may force the central bank to ease to a certain extent, not too much easing, but at least one more stimulus to start the economy or get the economy rolling again, right? So from a policy rate perspective, the underlying interest rates in the market, we feel that another 100 basis points reduction is very possible going into the second quarter of 2024, right? And what this will mean for interest rate is that there could be a further reduction, mainly on the shorter term treasury bill rates. We are already seeing banks and financial institutions cutting down their deposit rates. Particularly from last week, we saw all banks across the board cutting deposit rates by 1%. So all the renewals that you will see will start adjusting at a lower single rate if you are investing with the banks right now, right? From a growth perspective, like what I said, the growth is not phenomenal. It might be only about a 2.5% recovery, but at least the trend has reversed from a negative trajectory to now being a more positive trajectory going into 2024. And the reduction in terms of the economic activity or the slower economic growth is because of the hit that is coming from taxation and so on, which has slowed down consumption, and also because a lot of the capex projects that the government was doing has come to a halt, right? So these are reasons why the economy, which used to grow at 4-5%, will only hit at about 2-2.5%, right? And normally what you see in other countries who've gone through a restructuring phase is that actual recovery back to norm only happens like 2 years after the restructuring cycle, right? So typically 2025 is where you will see a better improvement or getting back to the 3-3.5 kind of growth rate, because the good news is that we have only one more tax adjustment that the government has to implement, which is the property taxes, property, wealth, and transfer taxes. After that, you're not going to see any tax increases because those are the only changes that IMF wants in terms of tax changes going into the next 5 years, which means that if there are no new taxes coming in 2025, you will see that people's income will increase and taxation will remain the same, which means that their purchasing power can increase going into next year. The good news is that the economy is recovering. We are seeing an improvement in activity, right? Even though it's not to the levels that we envisaged to be. The numbers, the key economic indicators are showing that things are moving back again, right? So your early indicators like electricity usage, cargo operations, tourism, all that is indicating that the economy is picking up, right? It just needs a little bit more stimulus to kind of activate the market towards the right direction. So we're looking at a scenario where growth is going to be about 2.5%. Interest rates probably reduce a little bit more, but not. We don't foresee single-digit interest rates from a treasury perspective. And also from a currency perspective, we feel that currency, which has appreciated in the last 2 to 3 weeks, might see a bit of depreciation going into the second half of this year. And we think that the currency might hit the 350 kind of levels again, owing to a few reasons, right? So because of imports being very low in the month of January, and that's because of the impact of taxation, not much of pressure on the currency because of the imports as such. But in the second half, when we see the benefits of low interest rates, the easing off that the government might do in lieu of elections, particularly on cutting down a little bit of taxation, reducing electricity tariffs, and so on, might improve the spending. And with spending, you will see imports coming back again, right? So imports coming back again, Sri Lanka concluding the external debt restructuring by the second quarter will mean that we need to start paying the interest component on foreign denominated debt, which roughly works out about $80 million of outflows that we will see going into the second half of 2024. In addition, the government may also look at easing vehicle regulation, the vehicle imports, where a certain component might be allowed to be imported, which also might start exerting pressure on the currency again. Right? So from a currency perspective, we believe that the currency might reach back again to about 350 to 360 rupees to the dollar by the end of the year. So under these assumptions, right, under these macro assumptions, what are the attractive asset classes right now? Right. So if you recall from our previous pictures, we said we were heavily going into government bills and government bonds because those rates were tremendous, right? So last year, January, I think Treasury bill was trading close to 28-30%, right? So now that interest rate environment has reduced, the risk premiums that the Treasury bills and Treasury bonds were offering has now substantially reduced, right? So from a investment perspective, you might, as an individual investor, if you're yield starved, you might have to kind of shift a little bit of your portfolio towards other asset classes, right? But still, the good news is that the government securities, which are risk-free, will offer a slight premium to the bank deposits, right? So, for example, if you look at the bank deposit rates right now, bank deposit rates are 8-9%. Government bills, you still can get about 11%, and on a longer security, you might be able to get about 12-13%. So, if you are looking at wanting to fix your returns, right, still the government securities might be an option compared to the banks, but from an overall asset class perspective, we would want to reduce our exposure to government bills and bonds, given that the other asset classes provide a better value proposition in the current context, right? So the key challenge right now is the low interest rates, right? So before I talk about the low interest rate environment and what it means for investments, let me give a little bit of color into where Sri Lankans invest their money and what that means for investments for 2024. Right? So if you look at the overall funds managed, I think there's roughly about 35 trillion rupees of money lying there invested in treasury bills and bonds, which is about 15 trillion, deposits with banks, which is about 10 trillion, equity market or stock exchange about 4 trillion, and the remaining components are very small. So you're looking at treasury bills and commercial banks being the larger component, or almost 90%, 80% in terms of your total investment portfolio, right? And this is from an overall perspective. But if you look at individuals and retailers' perspective, more than 85% of individual investments are still tilted towards deposits at a commercial bank. So the bad news is that Sri Lankans, roughly about 33% of the deposits lie in savings and current accounts, right? So which is a very large component. For example, if you look at a country like Singapore, this number might be about 19-20%. Right? Sri Lanka has a relatively higher current account and savings account as a percentage of their deposit. Even though when interest rates have been very high, people still keep their money in a savings deposit. And that is very value detrimental from investment perspective, because these savings and current accounts or savings account only give less than 3% from a return. And that means that you're not able to cover your inflation, which is running at 5 to 6% right now. And you're on a real return perspective, a lot of Sri Lankan population will end in a negative real return territory. Right? And if you look at other markets, you see mutual funds or asset managers, unit trust fund managers being a large component of the investment pie. In Sri Lanka, mutual funds or unit trusts only 1.8% of GDP, compared to countries like India, where it's about 14-15%. Countries like China are even larger. So, and why I'm bringing this up is that it's financial literacy which is keeping these numbers very low for alternative investment asset classes, and for people to or investors to still maintain a large part of their income in savings and current accounts, right? So in this context, what we suggest investors to look at is three main asset classes. One is unit trust, second is equities or the share market, and also we are highlighting a little bit of the debenture side. If you're looking at still wanting to lock in rates in a reducing interest rate environment, right? So to answer your first question, I think in terms of why not fixed deposit, why shouldn't you settle down for fixed deposits right now? A good example is to look at what the banks are offering right now in terms of the FD rates, right? So if you look at the banking sector overall, the average interest rate on banking deposits has now come to about 9%, right? And there's been roughly about a 1%, 1.5% reduction over the last 4-5 months. And this has been driven by the recent interest rate reduction from a treasury bill and treasury bond perspective, right? So from a deposit rate perspective, bank deposits have already come to single-digit levels, right? We don't think that treasury bills and treasury bond rates will come to single digits, right? But from the perspective of bank deposits are going to be very low in terms of your returns going into 2024. And keep in mind, this is about 40 or 50% of the investment market, right? So if you look at, if you're a tax-paying individual where you fall into the higher category of the 36%, if your total income is crossing 300,000 a month, you'll end up paying a 36% tax rate, right? So if you're making only 9% on your FD rate, after taxes, you're actually ending up with only 5.76%, which is very, very low, right? So you're almost in line or slightly lower than or slightly above inflation rates, right? So you're not really covering up for your inflation after factoring in the inflation impact to it, right? So the taxation is a large component, which is, compared to before, is eating out a large part of the real returns made by individuals, right? So your actual real return now on a fixed deposit will be about 0.25% after adjusting for the 5.5% inflation that we are talking in right now, right? So the good news is that the fixed income unit trusts are offering still high rates compared to the market. So when banks at 8-9%, the fixed income funds are giving about 14 to 15%. However, these yields are not locked. The rates change on a daily basis, but the yields offered will be anyways higher than what the banking system is offering right now, because what the unit trusts have been doing is they've been locking in rates in longer term securities before interest rates started coming down, and also they have opted for alternative asset classes in terms of fixed income, where they directly go to corporate borrowers, which is what is giving them a yield uptick in terms of their return right now. Right? So we feel that our funds should at least give a 3-4% advantage to the normal fixed deposit rates, at least for the next 12 months or so. Right? The good thing is also, I think I've spoken about this in the past, your unit trust, if you're not withdrawing the amount, you can postpone your tax payments. So if you want to know a little bit more about that, refer to our YouTube page where we have explained this in detail in terms of how the taxation works. So you only pay taxation on unit trust upon realization, upon withdrawal. So if you're just keeping your money in the unit trust and allowing it to accumulate returns in the fund, you don't have to pay taxes until the point you're withdrawing, right? So you have an advantage in terms of postponing your taxes, right? And depending on the tax rate which prevails at that particular point in the future, you just need to pay at the tax rate at that time for the cumulative years rather than paying taxes on annual basis. So you make a benefit on the compounded return, and also you have the advantage if tax rates will come down in the future, which is most likely going to be the case. There is advantage of parking the money in the unit trust, right? And just to recap in terms of the unit trust, obviously, these are more like a savings deposit. You can lock in for a short period of time. You can withdraw overnight. So they almost work like a savings deposit. Why they're able to give a higher return, like what I've said, is because of investing directly with corporates without going through intermediary channels. And also the professional expertise that comes in terms of predicting these interest rate cycles and all that kind of contributes to us giving a better return compared to the market. So these are options available. These are two main funds at the moment. We are looking at a few more options, but these are two key funds. And these funds, I think, cumulatively have almost close to about 70 billion in terms of assets under management. And this is a good example I just wanted to show you. So is it only a temporary thing, or is it a longer thing where by investing in the unit trust, you are able to outperform the market, right? So let's assume this fund that I'm talking about is one of our funds, or which is one of our larger funds, which is what you call the CAL investment grade fund, right? So if you had invested 100,000 rupees when this fund started in 2017, today the value of your return of that 100,000 rupees in 6 years' time or so is 254,000. Right? If you had just kept that 100,000 rupees in a savings deposit, that value of that today is only 123,000. Even if you had parked the money in a bank FD, working out the bank FD rates, compounding it over time, your bank deposits will be only 200,000 rupees, right? So the investment grade return cumulatively over the 6 years has been able to give a 25% return above even the fixed deposit, and double the return that you would have made by just keeping your money in a savings deposit, right? Which is why we are saying that unit trust, even from a longer term perspective, will be able to outperform the normal investment channels, right? And that is because of our structuring expertise, creating products which are attractive for corporates, as well as from an investment perspective. These are products that are attractive for individual investors as well. Right? So apart from unit trust, if you are looking at a more fixed term, fixed interest rate kind of investment kind of product, obviously unit trust is an option. But I would also want to highlight that equities, share market, should be more attractive, to be honest, given that interest rates have started to come down, right? So given that now interest rates are very low, you're getting impacted by taxes, I would suggest that you start allocating a little bit more towards investing in the share market as well, right? You can start by investing in slightly less riskier shares. Go for the blue chip companies. They're hugely undervalued right now. And normally what we've seen in the past is that when interest rates come down, markets go up, or the share market goes up, and vice versa, right? So there is a negative correlation between interest rates and the equity market, right? So when interest rates come down, equity markets go up, and similarly when interest rates go up, the equity market comes down, right? So with interest rates now starting to come down, your equity market should ideally start to perform well, right? Why? Because when you look at your deposits and so on, which are the large component of the investment universe, now when returns are very low, they are unable to cover up for inflation after taxes, people are looking at alternative asset classes, right? And equities, because of its cheap, you'll see people coming in more towards the equity market. So still the equity market hasn't started adjusting, which is where the opportunity is right now. And going into 2024, we feel that allocation from a portfolio perspective, equity should be overweighted compared to what we were doing over the last 2 years. Right. And why I say market cap or the equity market is cheap right now is if you look at inflation adjusted market cap from where the market was before to where the market is right now, the yellow line shows where the market is. If you are inflation adjusting it right now, it's at a huge discount compared to where it was, right? So the market hasn't moved in line with the inflation and so on, right? So normally what happens in other markets when inflation prevails is the equity market also kind of adjusts, right? Because companies reprice their pricing, right? So company profits also change, and also that reflects in terms of the market cap of the companies going up, right? But this hasn't happened, which is why the yellow line, which is where the inflation adjusted market cap is right now, is way lower compared to what it should be in the current context, right? So market is very cheap right now. If you look at the trailing multiple of the market, it's at about 11 times price to earnings multiple. You might think it's high, but the thing is it's on a trailing 12 months, which is reflecting very low earnings, which were reported last year, right? So with corporate profits going up in the second half of this year, you will see these numbers starting to adjust, right? We still have companies which are low single digits, and this will improve when corporate earnings or companies start showing more profits going into the second half of 2024. And why we say company profits will go up is A, because a lot of the companies have a lot of debt, right? And this debt is now reducing in terms of cost because of interest rates have come down. So a lot of the leveraged companies will see a reduction in terms of their cost of funding. Second is that consumption will start booming, right? So at the moment, things are very weak, but it will change. It will start picking up in going into second half of the year. And keep in mind, this is driven by credit becoming cheaper, right? People have been waiting and watching and postponing consumption. That will change. The government has a little bit more leeway in terms of cutting down taxes a little bit going into the second half. And also from the perspective of tourism and so on, we are in a very good position, which will also add to the economy in the second half of this year in a big way, right? So all of this will contribute to improve economic conditions going into 2024, unless there are any black swan events which could derail us from our path, right? So a lot of the people have questions in terms of whether Sri Lanka will have another problem in terms of domestic debt restructuring. What will happen then? Will we fall away from the IMF program? So my view is that Sri Lanka is unlikely to go into a second domestic debt restructure, given the current improvement that we are seeing on a fiscal position, right? So our tax collections are improving, right? So even though it has taken a toll on the economy, the tax collections have gone up, which is improving our primary deficit, which is revenue minus your cost of the government, has substantially improved. And we're seeing this after 20, 30 years of having a large part of our deficits under primary on negative territory. Now we are in a positive stage, which means that the government's borrowing requirement will gradually come down in the next couple of years, right? So the debt to GDP is reducing right now, right? Which means that that overall debt position improving will mean that we don't have to be worried about debt need to be restructured again going into the next 2 years, unless Sri Lanka deviates too much from a fiscal perspective, where they suddenly increase expenses, cut down on taxes substantially. We don't think that there is a real need for another domestic debt restructure as such, right? So you must be also thinking, okay, we're saying that government can cut down expenses or going to cut down taxes a little bit, but can they really do that, right? But if you look at the numbers coming in, the first half, the government is collecting a bit more in terms of the tax revenue collections. And the good news is that they are reducing the expenditure. And most likely what they're going to do is offload a large part of the expenditure towards the second half, towards closer to the elections, to kind of fuel consumption coming in, right? So this, without affecting the overall fiscal deficit of the country, can result in more consumption coming in the second half of this year, right? And normally, loan growth in the banking sector and the growth in terms of the equity market have a very positive correlation with a 1 year lag, right? So if credit has now started to grow, which means that in the subsequent towards the second half of the year, that should also mean that your share market will also start moving up, right? And credit, I think last month the banks lent about close to 100 billion rupees in terms of loans, and this is a significant increase compared to what we were doing before, right? So why loan growth matters is that loan growth is what kind of leads to economic activity, and when economic activity moves, you're going to see that reflecting in corporate earnings, and corporate earnings improving means that your share market investment should do well, right? So compared to before or the previous sessions, I'm giving a little bit more emphasis on the equity market because I feel that with interest rates coming down, there is a good opportunity, a good opportunity for equities to outperform in 2024, right? Despite a lot of the political risk and so on being factored in, my belief is that Sri Lanka is unlikely to deviate from the IMF program, given where we stand right now, irrespective of which political party comes into play. So we will have this fiscal discipline going in for the next 2-3 years, which will mean that if we have these reform agendas happening, Sri Lankan equity market should do well in the next 2 years, particularly with interest rates going to be remaining very low. Right. So the good news is that equities, from a taxation perspective, is very efficient, right? So compared to fixed deposits or any fixed income investment where you pay 36% if you're falling into the higher tax rate, equities is completely free from capital gains tax. So you only have to pay a 15% tax on your withholding tax on dividends. If not for that, there is no major taxation on equities, which makes it an even more compelling proposition for investments going into 2024, right? So with the IRD kind of really going in terms of income tax collections and so on, avoiding taxation on fixed income investments will also become very difficult, right? So you might have to pay your taxes on your fixed income investments, which will mean that your after-tax returns are going to be very bad on fixed income investments, which will make it more attractive for investors to look at equities as a more compelling asset class, right? So the good thing is that from a taxation perspective, equity will be only subject to a 15% dividend tax. Apart from that, there's not going to be any tax. And what we feel is that sometimes you can replicate your fixed income investments through equities as well, right? And you can do that if you invest in dividend yielding companies, right? So I was looking at a few options, and these are not a comprehensive list, but some of the decent, more less volatile companies, their gross dividend yields range between 8 to 14%, right? And from a net dividend yield perspective, after factoring this 14% tax, a lot of these yields will be between 7 to 12%, right? And so it's on a after tax perspective also, these equity numbers are looking better compared to the after tax return that you're going to get on FD, right? So if FDs are giving only 9% and you pay 36% on it, you're only getting 5.8% return, right? But in terms of equities, your after tax returns, if you're going for these dividend yielding counters, will be north of 7.5 to going up to even 11-12%, right? So there are more companies. Actually, I think there's about 25 companies for last year have been able to maintain a dividend yield which is in excess of 8 or 9%, right? So there's opportunity to kind of capitalize, and you're replicating a fixed product, a fixed income product through equities. And these companies are more stable in terms of share prices, which allows you to kind of make an additional capital gain if the share prices also move, right? So you'll get the minimum return from your dividends, and also you can kind of make a higher return if you make capital gains returns, and if the share market also starts moving up, right? So possible catalyst for the upward market movement, equity market movement, is definitely the key driving force will be falling interest rates. Second one will be the completion of the external debt restructure. And we very strongly feel that by June, we will have an announcement coming in. And it's most likely going to be between a haircut of 20-30% in terms of face value, which will mean that You're looking at a 50% loss for the sovereign bond holders, and that's likely more likely to go through in the second quarter of this year. The tax benefit of the equity investments also will be a positive for equity investments. And the other big one will be completion of some of these state-owned enterprises sales. If these state-owned enterprises are sold to a lot of these foreigners who are bidding for them, there's a lot of dollar inflows that will come into the country, and which means that the central bank can also buy these dollars and put rupee liquidity to the system, which will improve the overall rupee float in the system, which will flow into low interest rates and also the equity market in a larger perspective. Also, looking at past historical relationships, the governments always used to spend heavily ahead of election cycle, right? So even though first quarter has been slow, we feel that spending from a government perspective will kick in the second quarter ahead of the election cycle. And with the improvement that we will see on corporate earnings with the economic revival, we will see that the market earnings will improve, and that driving the equity market as well. So the market, which is at 11 times or so in terms of price to earnings multiple, will fall to about 8-9 times, right? Once the earnings start kicking in terms of performance. Right? So some interesting statistics. Now, people say that elections are a key driver in terms of spending and for equity markets. I've just put some data what I found from past election cycles in Sri Lanka. So if you look at Sri Lankan presidential elections from 1982 to now, out of 8 presidential elections, 6 of them, the government's spend as a percentage of GDP has increased compared to the previous year in 6 out of the 8 presidential election cycles, right? So governments tend to go and spend all out, particularly closer to the elections, to kind of stimulate growth and for the public to see the things that they are doing in terms of an economic front, right? So we are cautious on what it can do for the currency. This is why we are saying that currency can depreciate a bit more. But from a growth perspective, the fiscal stimulus will come into play, and monetary stimulus, the central bank will kind of more take a backseat in terms of making no more policy changes going into second half of 2024. And also from looking at how the share market has performed in the last 6 presidential elections, I've just looked calendar year returns. Out of 6 presidential elections, in 5 of them, the returns of the market has been positive, right? Even though the 2015 elections, I've just taken 2014 as a year because elections in 2015 happened on January 9. So a lot of the work actually took place in 2014, or spending and the markets rose in anticipation of the presidential elections. So normal tendency is that leading up to an election, 6 months ahead of election, markets tend to kind of run, and that's because of economy seeing slight bit of benefit with fiscal stimulus coming into play. Right? And this election phenomenon is not just a Sri Lankan one, right? So world over, you're seeing ahead of presidential election or political cycles, there is a bit of spend and markets tend to kind of do very well. So even in the US, the S&P 500 has provided a positive return 20 out of 24 times in a year of elections. Right? So we believe that going into this year, we will see some kind of spending coming from the government. The benefits of the monetary policy easing will come into play by the second half, and that will drive the market also, adding support to the benefit that we'll get from the lower interest rates. Right. So how do you invest in equities? There's 2 approaches, right? So you can be active in terms of market, buy your shares by yourself, open an account with us. You can even trade online, or if you're a larger client, we can onboard you with a stockbroker. So this will need a bit more effort in terms of picking the stocks, which our research will obviously help you, or Cal research will obviously help you in terms of picking the stocks if you're following us. If not, you also have the option of choosing our unit trust product, which is taking passive exposure to our equity fund, right? So a passive exposure to the equity market through what we call as a Cal quantitative equity fund, which is a fund which has existed for almost a decade now. and if you don't have the time and energy to research on companies and actively trade in the market, your best option is to go for investing it through the equity fund, because the fund managers here will do the work for you. They will do the research. They will pick companies for you and pool investments and invest it on behalf of you. So if you take a passive approach, like what I said, the Cal Quantitative Equity Fund is a means to the way of getting to taking exposure to equities. So this particular fund that I'm talking about has 4 billion rupees under management. Last year, the fund gave a return of 36.6%, when the all share price index only moved by 25.5%. And if you look at our fund since inception, I think that was in 2013, we've given a compound annual growth compounded by at least 13% since inception, right? So this has outbeaten fixed deposits and also your overall equity market. We've outperformed the market, and as what I'm showing in the graph, that's how our portfolio, the quantitative equity fund portfolio, has performed compared to the market starting from 2020. So equities is definitely an option. So you can directly invest in the equity market by opening a direct account. Your other option is, like what I said, to invest through a unit trust and take exposure to the equity market. The other option, if you have a need to lock in long term, right, and if you want to reduce with rates coming down a little bit more, if you want to hedge some of the risk by locking in longer, debentures is an attractive asset class, right? So some of the debentures are still coming in at relatively higher rates. When I say higher rates, now we are talking about a 14-15% rate being a very high rate. We are not going to see that kind of rates for government securities in the near 12 to 24 months, right? Your government securities will be at about 11-12%. And if you want to lock in longer, you might have to take the route of investing in debentures and so on, which will offer 1 to 2% premium compared to what you will get on government treasury bills and government treasury bonds, right? So if you want to hedge yourself for further interest rate reduction, debentures is a product to lock in for a longer period of time, right? So from time to time, there are debentures coming in, and from decent credit rating institutions like the banks, which are raising money right now, and that will mean that you might be able to still find somewhere in the north of 14% in terms of a return on a debenture or so, right? So these are our investment options right now. So we are tilting more towards 3 products, which is your unit trusts, equities, and debentures, which we feel will outperform in this year. We would increase allocation to equities substantially this year, given that your fixed income returns have fallen sharply and not covering for inflation, and also reduce exposure to government securities, given that now you don't get a compelling proposition for higher rates. So you will only go into government securities most likely if you are investing in fixed deposit products, which are very low right now, and your government securities, if you want to lock in for a year or so, still will provide you about 11.5% in terms of yield. So that's a summary in terms of what we are looking at in terms of 2024. You have to make a shift in terms of your asset portfolio or investment portfolio, because you're looking at a different interest rate regime, right? So you're not going to see those 20% interest rates anytime soon. So you need to tilt your portfolio to kind of facilitate, to capitalize on the recovery in the economy, as well as the low interest rates that are going to prevail. So when I say low interest rate, 10-11% is low interest rates from a Sri Lanka perspective. And after tax return, obviously after 36%, will be very low, right? So these are options, and I'd be happy to take a few questions from the audience. One question, you said unit trust is similar to savings account, but can guarantee the capital amount that going into investment can be safe. So to be honest, we can't guarantee returns, but if you look at historically, we'll never had a default in any of our investments. And the good thing is that a lot of it is in products which are yielding fixed interest, right? Which means that most of the time it's on an upward sloping improvement in terms of the fixed rates, right? So your unit trusts normally go up on a day-to-day basis. There are a few instruments which might be marked to market, but those are temporary issues. I've explained this, I think, in my previous session, where slight one-day reductions may happen because there are a few investment products which will be marked to market on a daily basis. But if not, a lot of your products are fixed instruments, which means that it's an upward sloping improvement, right? So if you look at our fixed portfolio, I think it has given a 12% annual return over the last 10 years or so. So there's another question: can we expect the current forex rate to hold during 2024? So if you look at it, the first month of January saw an improvement on the currency, right? So currency, which was at 325, 326 to the dollar, has appreciated about 312, 313 rupees to the dollar. And why this happened was, like what I said, there has been not much of imports because of tax impact coming in, people postponing consumption. Second is that banks were heavily buying dollars in the month of December to accumulate positions for sovereign bonds, or to facilitate any possible impact coming in from sovereign bond haircuts. So they've stopped accumulating dollars. Third is that it was raining heavily, so Sri Lanka didn't have to import a lot of fuel, right? So that also kind of helped in terms of the currency. Then tourism was super months for December, January, and February, which has brought roughly, I think, for last month, we made about $350 million just from tourism. So second half might be slightly different. These are weaker periods for tourism because it's off season. And also, as what I said, when government starts spending, when starts lowering interest rates, people are going to start spending a little bit more. People spending more means that imports will pick up, and that will put pressure on the balance of payments. Then from a debt perspective, because we'll be concluding external debt restructure, every month we'll have to pay roughly about $70-80 million in terms of interest payments starting in from the second half of this year. So these are all payments pending to be going out. And also, if they allow vehicles to be imported, that might also exert a bit of pressure, right? So vehicles are a large component for tax collection, which might make it lucrative for the government to kind of ease off. But obviously, we expect currency pressure to come in because of that. So currency, we are looking at currency reverting back to about 350, 360 by the end of the year, unless we have huge foreign inflows coming from our bilateral lenders, or we are able to sell a large part of the SOEs that we are currently kind of putting up for sale. We feel from a base case perspective that the currency should depreciate. So which sectors will you see immediate gains in equities, right? So I'll not be stock specific, but talk about a few sectors. I think the easier one to pick right now is banking, right? So banking is the one which is hugely undervalued right now. They pay dividends in the first quarter itself, so you can hedge part of your risk through dividends. They provided for sovereign bond losses and so on. It's trading at 30 cents to the dollar in terms of the net asset value, or 0.3 times net book value. You won't find banks trading at these kind of valuations after providing for restructuring impacts. So banks are the easiest one to kind of hedge your risk with. And even from a longer term perspective, you don't have to worry about it. The other wave I feel will come from consumption, right? So if we are expecting consumption to pick up, consumer related stocks are one thing to pick up. So what I would want to say is, don't make judgments based on what things are looking today. Still, inflation is, people are feeling the pressure, but 6 months down the line, things will be slightly different. So pick the consumer run ahead of time is what I would want to kind of say. So how do we know what debentures are coming up in the future? So there's no pipeline that kind of comes in, but for example, when Cal does it, we kind of promote it on our channels, social media and so on, if we are doing a raise. So those will be advertised if they come in, but it's not like every week or every month we have a debenture. So it's a product which kind of activates depending on the company's requirements and so on. But a lot of the banks are in borrowing stage right now, which means that a lot of them will start coming in. Another question is, via the quantitative equity fund, are dividends paid annually, presuming the funds invest in dividend paying stocks? So dividends are reinvested in the portfolio. So they are normally not paid out. The fund most of the time or has historically been reinvesting the dividends back into the portfolio, buying more shares and so on. So can you recommend some example stocks which will be attractive with the reduction in interest rate? I'll not mention stocks, but go for high leverage companies, right? So any company which has a large amount of debt compared to the equity component would have seen a massive hit in the last couple of years, right? Because they were paying 30% interest. Now those interest rates will be at about 11, 12% for them now, right? So if you're looking for those particular counters, it's a research department that you need to talk to. They will give you guidance in terms of which particular stocks which will really give a benefit in terms of picking in a low interest rate environment. But if I were to give you a broader categorization, look for companies which are heavy in terms of gearing or borrowings right now. So where will the money market funds will be invested by Cal in 2024 to ensure higher return with minimum risk? Right? So our skill set is structuring products, right? So with the help of our investment banking team, we go to corporates and we structure products, right? So if the fund was heavily tilted towards treasury bills and treasury bonds last year, now there is opportunity coming up in the corporate debt space, right? So your typical commercial papers, securitizations, those are the things which give you that opportunity, right? And why it's good for you to invest through this through the unit trust platform is that you will never be able to access a lot of this commercial papers or securitizations and so on. If you're an individual client, or particularly if you have a lower ticket size, you will not get access to those products, right? So scale gives you that advantage by investing it through a unit trust platform. During the year, during this year and by end, rates have been going down. So at present, I invest now in the unit trust. Can I expect a return more than a fixed deposit rate at a bank if I withdraw the amount at the end of the year? So like what I showed you in the graph, yes, we should be able to outperform. And why I'm saying this is because the unit trusts have been able to lock in some of these products at a higher rate, right? When the interest rates were higher, right? But your bank FDs reprice every month or so, every day the rates are coming down, right? So these funds, unit trust funds, have locked in part of our investment, right? And like what I've shown in a historical perspective, your returns should be greater than your bank deposits for sure. Considering high taxes, especially the availability of funds among retail investors has been impacted. If the high taxes continue, how do you see the market will perform? So even with taxes being low, now say for example, for the equity market, it's not a big market. It's only a 4 trillion market that we're talking about, right? The deposit market overall, we are talking about a 10 to 11, or putting finance companies together, you're talking about a 12 trillion rupee market, right? So if you look at average monthly turnover, Sri Lanka only sees about a 30 billion rupee turnover for a month in terms of equities. So even if say 1% of money comes from deposits to equities, right, which is you're talking about say 10 trillion means you're talking about that's roughly about 100 billion coming into the equity market. Right? So it's a small shift from deposits to equity that needs to happen to make a big change, right? So even if taxes are high, if people shift their asset allocation, I'm saying new money creation might be less. People might not be making higher return or higher incremental addition to their investment portfolio. But within the investment portfolio, right, there can be a shift that can result on the existing money that people have. People might shift it around. Yes, I agree with the fact that new money creation, a lot of people won't have new money to invest, right? But most likely what is going to happen is when their deposits now, all their bank deposits are maturing now. And when that happens, people are going to start looking for, okay, doesn't make sense to make 5% after taxes. I need to invest my money somewhere. So that will drive your equity performance. Do you see a significant impact on the export-related companies once the US Fed rates start going down? And if so, do you expect this to happen? So I think it's very clear that the Fed will start easing rates. And I think going into 2025, we will see that happening. Export companies, I think apparel and so on will kind of get back to where they were. But it doesn't mean that there's a level that the exports can kind of grow to, right? So you won't see phenomenal growth in the export arena because the reduction has been only about 15, 17% on a lot of the exports because of the recessionary conditions. So that will correct automatically in the next 2 years, but doesn't mean that you're going to see a huge run, particularly on export companies, at least from a dollar perspective, export revenue collection perspective, because large part of our exports are very inelastic products, right? So basic garments, tires, rubber products, tea, and so on. These are more inelastic compared to elastic products, which will do well when rates are going down and tend to kind of benefit. So I'll stop there for today, but just want to reiterate the fact that there needs to be a change in terms of how you look at investments going into 2024. And with rates being low, you need to be more active in terms of managing investments if you want to beat inflation from an after-tax perspective, right? So on that note, I will conclude my session and hope to see you soon in another session next month. Thank you.